Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Dan Bell, Director of Sales at HiFX, with our regular look at the currencies world. Welcome in, Dan. Thanks for joining us.
Thanks, Gareth.
Look, it's been a very volatile little period in the global markets, and I guess now people are looking ahead to the all-important Federal Reserve FOMC meeting this, next month, September, in a couple of weeks, the 16th and 17th.
That's
We've
right.
been waiting and waiting and waiting to see if the Fed is going to hike interest rates finally after obviously the GFC in a 9-year period where they haven't.
Yeah.
What is the market tipping now?
Yeah, no rate hike in September is the market's call. Obviously the last time we caught up about 5-6 weeks ago, the market was pretty much sure that the Fed were going to start raising interest rates in September. So take the Fed funds rate from its current level, which is basically 0 to 0.25, adding 0.25 to that. So with the volatility that we've had in China and the Chinese stock market over the last couple of weeks, which has flowed through to global equity markets, everyone has pushed back the next Fed hike until either the end of October or the middle of December, which are their next meetings.
Okay, so we're going to have to wait a little bit longer.
We are. I mean, it continues to be a big focus of financial markets. Obviously, what the Federal Reserve do around interest rates has global implications. There was talk that the Europeans were also reaching out to the Fed, saying, "Listen, we don't think now's a good time to be raising interest rates," whilst the European region was still sort of trying to get on their feet. And obviously, with this volatility in China, any type of the extreme volatility that we've had recently is always going to cause some concerns, and we've seen the weakness in the US equity markets. Obviously, commodity prices continuing under pressure, oil prices dropping under $40 a barrel. So, when you get that level of uncertainty in those types of sort of price responses in the markets, there's question marks whether now is actually a good time to be raising interest rates in the US.
And as you were saying there before, I mean, China's been an incredible story of late with the share market there, big falls in that, and that sort of flowed through to other share markets around the world. I mean, this has just sort of replicated itself through to the currency markets too, and I guess the New Zealand dollar, the risk has been off, hasn't it, there?
Yeah, it has, big time. And I mean, the other day we had that huge move in the New Zealand dollar, a flash crash of sorts really, because at about 1 a.m. in the morning it was trading around 65 cents, and within seconds it was trading around 62 cents, and then within 15 minutes it was trading back around 64 cents. So that was obviously huge volatility following the massive drop in the Chinese market, and then the big drop in the US markets when they opened. So these sort of moves can be pretty crazy, and of course a lot of fear and panic on that day. I mean, they were reminiscent of the level of volatility that we saw in 2008 when Lehman Brothers collapsed, which was days when the Dow Jones and and commodity prices were down sort of 4 or 5% in a day. So pretty nerve-wracking stuff. But the reality is, I mean, the Chinese stock market, the Shanghai Composite Index has gone from back in August up through to June, rallied over 120%. And that was despite slowing earnings growth in China. So the reality is that the movement that we saw in the Chinese market wasn't sustainable, and really we are just seeing a correction. Unfortunately, that correction has been pretty abrupt and can cause a lot of concern. But the bottom line is the Chinese stock market had no real rights to be rallying like it was. So we are seeing it come back down to earth.
And back in New Zealand, we've got another Reserve Bank review of the OCR and a monetary policy statement coming up on the 10th of September. What are we expecting this time?
Well, we're expecting the RBNZ to cut interest rates. That's pretty much a given. I guess where the RBNZ is now is looking ahead. I mean, the currency has done its job in terms of cushioning the impact from these weaker commodity prices. So New Zealand dollar trading around 64.5, 65 against the US, and we are significantly down against the euro, the pound and the Japanese yen year to date, over 20% against those currencies as well. So a weaker New Zealand dollar obviously making it more appealing for our exporters. And offsetting some of the weakness that we're seeing in those commodity prices. So I think that's going to be a big feature of the monetary policy statement. Obviously, there doesn't seem to be any inflation out there. Certainly, globally at the moment, inflation is nowhere to be seen. And with the weaker oil prices that we're seeing, it's very difficult to see where inflation is actually going to come from. So I actually think we're in an interesting period where I think central banks are actually starting to reflect on what this low inflation environment means, and whether or not they have to change the underlying paradigm that assesses inflation and assesses the economy. Because some would argue that if the outlook for inflation is so low, then interest rates are never going to go up. And yet that kind of reflects a more pessimistic outcome or view of the global economy. So it's an interesting time for what the policymakers are going to do around that inflation story.
And still plenty of uncertainty out there, I guess, isn't there?
Yeah, look, there is always uncertainty. I guess what these periods of volatility do, though, if you want to actually sort of look for the silver lining, is that Chinese stock market has a big drop, long-term interest rates go down, and that's an underlying positive. So, in a way, when you see these periods of volatility and you look at the New Zealand context, I guess people are focused on the housing market in Auckland as an example. What this volatility is doing in China is actually saying, well, there's so much volatility or uncertainty out there when maybe there's not as much volatility as or uncertainty as there really is, but it is forcing interest rates to go lower and obviously getting these sort of policy responses from central banks to continue to keep interest rates lower, which in turn is continuing to support asset prices. So I guess if you're in the housing market or the equity market, happy days. A little bit of volatility in the short term is actually pretty good in the long term, because now long-term interest rates keep going lower because of a bit of weakness in the Chinese stock market. So.
Yeah, no, interesting times. Now, before we get to the Reserve Bank's OCR review, we're going to have a Reserve Bank of Australia cash rate review tomorrow, in fact. What are we anticipating from them this time?
No change expected from the Reserve Bank of Australia tomorrow. Their cash rate is already at 2%. Obviously, ours is at 3%. So, I think the RBA are pretty happy with the cash rate where it is. We have seen the big weakness in the Australian dollar already. The Aussie dollar to the US trading down around new sort of 6-year lows, under 71 cents recently. Go back, a couple of years ago, and the Aussie dollar was trading well over parity. So there's been a huge fall in the Aussie dollar, and again providing that support to other sectors or export sectors outside of the commodities and resources side of their economy. So I think the RBA is on hold for the time being.
And just, I guess, with a little bit of crystal ball gazing here, with the Kiwi dollar, what can we expect in the next couple of months? I mean, we're sort of in the mid-60s against the US at the moment. What can we expect against the US and the Aussie dollar and some of the other major currencies?
Yeah, look, I think where we are at the moment against the US dollar, feels about sort of fair value, really. But in the longer term, the medium to longer term, I still think the New Zealand dollar's got more downside against the US. But for the time being, we could see a bit of consolidation around these current levels, and maybe we do see it sort of push up a little bit higher, particularly if the Fed come out and hold off. The data flow out of the US has been pretty good lately. So if you actually look at the underlying fundamentals in the US economy, durable goods orders very strong last week, consumer confidence, retail sales. We've got US employment figures out on Friday night, again always closely watched by the Fed and the market, expecting employment growth for the month of August to come in at around about 220,000 new jobs, their unemployment rate down at 5%. So I think the US dollar is still in an uptrend against most major currencies, which means I think we've got further weakness, further downside in the New Zealand dollar US, probably down into the low 60s, potentially in the high 50s if we continue to see the cycle unfold in commodities.
Yep, sorry, go on.
And against the Australian dollar, we're actually relatively stable there. We're sort of sitting around 90 cents and trading a range between sort of 88 and 92, so we're relatively stable against the Aussie dollar, and it's probably going to be the case for a little while.
And obviously quite a bit weaker, 20% down, you were saying, over the year against the British pound.
Correct, yeah. So against the pound, we've dropped from over 50 down to as low as 40p at one stage. We're back around sort of 41.5p. Against the euro, I mean, a dramatic move against the euro. It was only sort of 4 months ago that we were trading over 70 against the euro, which was post-float, all-time highs. And now we're sitting around 56, 57. So, it's somewhat sort of counterintuitive sometimes to see these sort of moves when you look at all the issues going on in Europe. But the New Zealand dollar has probably been one of the weakest currencies over the last few months. So investors have really fallen out of love with our currency as these commodity prices have come off and expectation for lower interest rates. So we are very, very susceptible to changes in investor sentiment and global appetite for our currency. But look, it's a good thing when it comes to providing a bit of a buffer for our exporters.
Absolutely. Thanks a lot for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with our Never a Dull Moment Currencies Report.